In recent years, commission-free trades have become increasingly popular, with a number of different brokerages offering them. However, there is still some controversy surrounding this practice. Some argue that commission-free trades are simply a way for brokerages to lure in new customers, and that they ultimately end up costing retail investors more money in the long term. Others contend that commission-free trades are a fair and reasonable way to trade, and that they offer significant benefits to investors. In this video, I'm going to explore the controversy around commission-free trades. Are they really as good as they seem? We'll find out today. For those of you who are new to the channel, welcome. My name is Neera and I'm a financial analyst. I talk about personal finance and investments and teach you how to make money and grow it exponentially. If you're interested in the subject, consider subscribing, as this will help the channel grow and impact more people. First, let's talk about what is a brokerage account and what it can be used for. If you're familiar with them, feel free to skip to the next chapter. At first glance, a brokerage account may look a lot like a bank account. Both offer to save money and earn interest on your savings. However, there are some key differences between the two. For one, a brokerage account is designed for investing, while a bank account is primarily for your daily transactions and savings. This means that a brokerage account offers more opportunity to grow your money, but it also comes with more risk. With a bank account, your money is FDIC insured, meaning it is guaranteed by the US government up to $250,000. This protection does not extend to brokerage accounts, even the cash part. This means that if your brokerage goes bankrupt, your money may not be protected. Secondly, banks provide customers with a wide range of services, including personal and business banking, loans, credit cards, and etc. Brokerages, on the other hand, are focused solely on investing. They offer products like stocks, bonds, index funds, and most of them don't have physical branches where you can do your banking. Online brokerages accounts are more popular with lower fees. It is important to choose a brokerage account that is right for you. There is no one-size-fits-all solution. Instead, it is important to select an account that aligns with your unique goals and investing styles. Whether you're looking to grow your savings for retirement or you're seeking short-term profits, there is an account that can help you achieve your objectives. The key is to do your research and carefully consider all of your options before making a decision. Therefore, before you can start investing, you need to have a clear idea of what your goals are. Are you looking to grow your wealth over the long term, or do you need to generate income right away? Do you want to take on more risk for the potential of higher returns, or are you more comfortable with lower risk investments? Answering these questions will help you determine what types of investments are right for you. Once you know your goals, you can start researching specific brokerages and comparing them to identify the one that is more suitable for your specific needs. For instance, if you don't like to risk and prefer passive investing strategy, you might want to invest in index funds and ETFs. So the brokerage that you pick should have a big selection of no-fee to low-fee funds. If you're looking to more active management, on the other hand, a brokerage with good customer service and access to quality research could be a better fit. No matter what your goals are, it is important to do some research and make sure that your investments are aligned with them. Otherwise, you could end up losing money instead of making it, which brings me to my next point. Fees are the most complicated aspect of brokerages and could end up significantly eating into your profits. Average cost per trade used to be between $5 to $9, but thanks to online platforms, specifically Robinhood, the brokerage industry has become much more accessible and affordable by introducing commission-free trades in 2015. No longer do you need to pay expensive fees to get access to the best investment products. Now you can open an account with any number of online brokerages and get started investing with just a few clicks. However, it is not as simple as it sounds. A hot topic around brokerage fees is payment for order flow, a controversial subject around how commission-free brokerages actually make money that is banned in countries like the UK, Canada, and Australia. The term payment for order flow refers to the practice of some brokerage firms paying for the orders that they send to market makers. This practice is controversial because it can conflict with the interests of the firm's customers. For example, if a firm is paid more for sending an order to one market maker over the other, it may be tempted to send the order to the market maker that pays more, even if it means the customer will get a worse price. Therefore, it is important to understand how your broker makes money and whether they receive payment for order flow. The question arises as to why would a brokerage want to accept payment for something that should be part of their service? The answer, simply put, is that it is a way for them to make money and keep offering commission-free trades. And while there is nothing necessarily wrong with that, it is important to understand how payment for order flow works and how it can affect your trading. In a nutshell, when you place a trade through a brokerage that accepts payment for order flow, your trade is not immediately sent to the market like NASDAQ or New York Stock Exchange. Instead, it is routed to one of the many so-called market makers who are willing to pay for the right to execute the trade. These market makers are typically large banks or trading firms who make their money by buying and selling stocks amongst themselves. Because they're always looking for ways to get an edge on the competition, they're happy to pay for the opportunity to execute trades. And while this may not seem a big deal, it can actually have a significant impact on your trading. In December 2020, for instance, Robinhood was charged with misleading customers about revenue sources and failing to satisfy duty of best execution. In other words, by promoting commission-free trading, they forgot to disclose that they are getting paid for those orders by another party that wants to execute the order instead of the market. That creates a conflict of interest. As a result, Robinhood would send these orders to a third party who paid the most, regardless of the price, to the customer. The prices that the customer got were lower than if Robinhood would have sent it directly to the market. The SEC found that even after accounting for free commissions, Robinhood's customers were $34 million worse off as a result of this practice. While the practice in itself is not wrong, but your brokerage might not put your interest first and won't get the best possible price for your stock. Here's what I mean by that. For instance, if you place an order to buy Amazon stock, the broker receives a request from two different market makers. Market maker A pays your broker 60 cents and will execute the trade at $90. Market maker B pays your broker 50 cents and will execute the trade at $89. And the broker can get the stock on NASDAQ Stock Exchange for $90.98. In this scenario, the payment for order flow is actually good since it saves you close to $2 and the broker receives payment to keep offering you commission-free trades. The problem arises when the broker chooses market maker A to execute the order in order to receive more money. Fortunately or unfortunately, this practice is legal in the US and quite a few brokerages are using this as another source of income. Therefore, it is up to consumers to protect their interests, and here are some suggestions you can use. Number one, before you choose an account, it is important to examine the pricing and details of the execution closely. You should pay attention to how quickly trades are executed. Some firms execute trades very quickly while others take longer. This will affect the price of your trade. Number two, look for brokers with a track record of reliability. There are a lot of brokerage firms to choose from, so it's important to find the one that is reliable. A good way to do this is to look for firms that have been in business for a long time and have a good reputation. One factor to consider is the proportion of the brokerage revenue from this practice. There are risks of choosing the brokerage that makes most of their money through payment for order flow. For example, if at any point the SEC decides to prohibit this practice, these brokerages could go under and take your money with them. Or since the existence of the brokerage is dependent on those fees, it makes them more prone to act on their own interests instead of you as a customer. Number three, consider putting in a limit order instead of a market order to minimize these costs. It gives you more control over the price you pay or receive for a stock. With a limit order, you set a specific price that you're willing to pay or accept, and your order will only be executed if the stock reaches that price. Limit orders can be useful when you're trying to get the best possible price for a stock. However, there is no guarantee of execution. So while free trades and low commission may be tempting, be sure to consider all of the factors before choosing a brokerage. Payment for order flow may not be right for everyone, but it's important to understand how it works before making your decision. If you like this video, leave us a thumbs up, subscribe to the channel, and make sure you turn on notifications to never miss out. Check out my other videos on the channel for other money-making ideas you don't want to miss out on. As always, thanks for watching, and I'll see you next time. Are more popular with lower fees. Oh, did I just say mall? In December, tell me I'm done. Tell me I'm done. Tell me I'm done. Tell me I'm done.